everyone, this is my first video for class 11 commerce and the subject is accountancy. Today's topic is from unit 1, Introduction to Accounting. In today's video, I'll explain you the meaning of accounting. But before I explain you the meaning of accounting, let me tell you the need for accounting. Accounting is important for a business as it helps the business to maintain proper and systematic records of business transactions. By maintaining proper and systematic record of business transactions, it helps a business to ascertain the profit or loss it has incurred at the end of a financial year. The proper records also help a business to know the financial position at the end of the year. So let me explain the meaning of accounting. Accounting can be defined as the process of identifying, recording, classifying, summarizing, and interpreting. So let me start with the first step. The first step which is required in accounting is to identify business transaction. Only those transactions are recorded in the books of accounts which are related to the business and can be expressed in monetary units. So before recording any transaction in our books of accounts, we have to see that those transactions should be related to the business and they can be expressed in monetary units. If the transactions cannot be expressed in monetary units, they are not recorded in the books. So to explain you this, let me give few examples. Salary paid to employees, machinery purchased, and strike by workers. In the three activities, we can see that all the three activities are related to the business. But if we look at the three activities, we can see that salary which is paid to employees can be expressed in monetary units, as we can say that the salary which is paid to employees is rupees 10,000. Machinery purchased can also be expressed in monetary units, as we can say that the value of machinery purchased is 1 lakh rupees. But strike by workers cannot be expressed in monetary units. So the first two transactions would be recorded in the books of accounts, but the last transaction or the last activity which is related to the business but it cannot be expressed in monetary units, so we cannot record this item in our books of accounts. So the first step of accounting involves identifying a transaction. We identify whether the transaction is related to the business and it can be expressed in monetary unit or not. The next step in accounting is to record these transactions. Business transactions are first of all recorded in a book called the journal book. And if the transactions are more in an organization or the size of transaction is huge, then the business can open subsidiary books. The subsidiary books are in aid to the journal book. They can be in the form of cash book, purchase book, sales books, etc. The number of subsidiary books will depend on the size of the transactions in an organization. Let me show you an example of a journal book, how we do the recording in a journal book. I am not showing you the recordings of the subsidiary books because the video will become too long. So let me just show you how the recording is made in a journal book. Now before I show you the recordings, let me show you the format of a journal book. When we open the pages in a journal book, this is the format that we will find in all the pages. Now the first column is related to the date of transaction. The second column is the particulars column where we write the details of the transaction. Then it is followed by the ledger folio. The ledger folio is the column in which we write the page number of the second book that we use it, as all the posting of the transactions which are made in the journal are made in the ledger book. So the page number of the ledger is entered in this column, followed by the debit column and the credit column. These are the columns for writing the amount of debit and the amount of credit. So let me show you a few examples of the recording that is made in a journal. Here my main idea is to show you the picture of the journal book. The rule of recording is, I'm not concerned with the rule of recording because you will be learning this in details in the coming videos or the coming sessions. So here I will just show you how we record in our journal book. The rules you will be learning it later, but then I'm just showing you a picture of the journal book. Now here we have some transactions. These are all related to the business and can be expressed in monetary units. So when we record in our books, this is how we are going to do the recording. The first transaction was on 1st January 2019. The transaction was related with sales of goods for cash rupees 12,000. So when we record this in our journal, we write the date of the transaction and the particulars of or the details of the recording. That means we use the rule of debit and credit, and then we record, because in this transaction two accounts are affected, that is the sales account and the cash account. So according to the rule, cash account will be debited and sales account will be credited, and the amount involved here is 12,000. So we entered 12,000 on the debit side and 12,000 on the credit side. Similarly, if you look at the second transaction, the same date, the transaction is related with purchases of goods for cash. So here again, applying the rule of debit and credit, we enter the date, and according to the rule, we debit the purchase account and we credit the cash account. The amount is 1,000 debit and 1,000 credit. Then on the second, we can see salaries was paid in cash. So we write the date, according to the rule again, we enter it, salary debit and cash account credit. The amount is 5,000 debit and 5,000 credit. Then on the third, the transaction was related with sales of goods for cash. So we apply the rule again, then we write cash account debit to sales account, and then the amount is 4,000 debit, 4,000 credit. So this is how we do the recording. By applying the rule of debit and credit, we make the entries in the journal book. So this rule and the way of recording has a separate topic, so you will be learning this in details. This is just an idea that I'm giving you, like what we do it in accounting. That means after the step of identification of the transaction, the second step which is involved is to record the transactions in the first book, which we call it as the journal book. So this is the picture of the journal book. Now, after the recording is made in the journal book, the next step involved is classifying the transactions. All the transactions which are recorded in the journal book is made in a chronological order. That means on a daily basis, the recordings are made in the journal, and the recordings which are made in the journal are then classified into different accounts. So these accounts are shown in a book called the ledger. So in classification is the process of grouping the transactions of one nature at one place in a separate account. The book in which the various accounts are open is called a ledger book. So all the transactions which are of similar nature an account is open for such transactions, and these accounts are open in the ledger book. There are various accounts which are open in the ledger book, like the customer's account, the supplier's account, the purchase account, the sales account, the salaries account, and the commission account. So let me show you a picture of the ledger and the format. Now the ledger, the pages of a ledger has this format in the T shape. On the left hand side we call it as the debit, on the right hand side we call it as the credit side of an account. Now the columns that we have in a ledger is, in every pages we'll have these columns. The first column is the date column of the transaction, which is followed by the particulars, then the journal folio, because the posting in the ledger is made from the journal. So we have the page number from where the transaction has been entered from the journal book. The page number is given in the journal folio, which is followed by the amount column for the debit amount. Same way, if the entry is to be made on the credit side of the account, then we have the date column, then the particulars column, then same, the journal folio, the page number of the journal, and then the amount, credit amount. So this is the format of the journal of the ledger, and this format we can find in all the pages in the ledger book. So in the ledger book we have separate accounts are open for separate items which are recorded in the journal or the subsidiary books. Now this was the example that I've showed you a while before, where I showed you how we make the journal entries. Now let me show you how we make the ledger accounts in our ledger book. Now if you look at the journal entries, we can see the different accounts which are visible to us. One is the cash account, we have the sales account, we have the purchase account, we have the salaries account. So these accounts have to be opened in the ledger, and all the transactions related to such accounts are posted in the ledger. For example, I'm not showing you all the accounts, but some accounts I've opened here to just help you understand. So here I've opened the sales account, I've opened the cash account, I've opened the purchase account. Similarly, we also need to open the salaries account. So whatever accounts that will appear in the journal, we have to open that in the ledger book as separate accounts. So here I'm just for an example, I've just opened 3 accounts. So here I will show you how we do the posting in our ledger accounts from the journal. Now for example, let me take the sales account first. Now if you look at the entries, there are only 2 accounts, there are 2 transactions which are related to sales. So when we do the posting for this, like let me take the first transaction, the date is on the 1st. Now according to the rule, the sales account in this case is credited. The cash account is debited and the sales account is credited. So if we have to make the posting in the sales account, then we go to the sales account. Since the sales account is credited, we will make the entry towards the credit side of the sales account, and the entry will be made here, the date we enter it. Then the sales was cash sales, so we write here as cash here by cash account. The amount involved was 12,000, so we enter the amount 12,000. Then the next transaction was on the 3rd, so we write the date as 3rd. The reason here is cash sales, so we write as sale for cash. The cash account is credited, and then we write the amount as 4,000 rupees. So this is how we do the posting in our ledger account. So all the transactions related to sales will all be posted from the journal to the ledger book in the sales account. Let me show you another example, the example of cash account. If you look at the cash transactions in the journal, all the 4 transactions are related with cash. So here the posting will be made like this. There are some cash accounts are debited and some entries have cash account as credit. So let me show you the first one. The cash account here is debited, so I go to the debit side of the cash account and enter the date of the transaction. So I go to the debit side and enter the date of the transaction. The reason is sales, there was cash sales, so I write to sales account, the amount is 12,000. Then let me go to the next transaction. The next transaction shows here that the cash account is credited, so I have to go to the credit side of the cash account. I write the date, then the account is, the cash was paid because of purchase of goods, so I write by purchase account, the amount is 1,000 rupees. Then again the next one we have on the 2nd, here again the cash is credited, so I have to go to the credit side of the cash account, and the amount was paid for salaries, so I write the date on the 2nd, the account is by salaries account, the amount is 5,000. Then the last transaction is related to sales. I go to the cash account, the cash account is debited, so the date is 3rd, so I write the date first, 3rd, then the account for which the cash was received was sales, so to sales account, the amount is 4,000. So this is how the posting is made in the ledger, and we have to do this for all the other accounts also, and this continues throughout the year. The recordings are made in the journal and the posting is made in the ledger book in the various accounts from the journal or the subsidiary books. After the classification of accounts, the step of classification of accounts, that means the formation of various accounts and postings are done in those accounts from the journal or the subsidiary books. The next step which is involved is the summarizing of the transaction. In summarizing, the steps involved are to balance the ledger accounts which are opened, and with the balances and the account we make the trial balance, and with the help of the trial balance we make the final account. The final account consists of the trading profit and loss account and the balance sheet. Now, to make you understand, I will show you an example here. Now, by now you know in classification we open separate accounts, and the posting is made throughout the year from the journal or the subsidiary books into the various accounts in the ledger book. Now, at the end of the year, we close all the accounts and try to find the balances. So here, when we close the account, we can see that the account is closed for cash at the end of the year. The balance is 9,700 for cash. So the closing balance of cash is 9,700 for this organization. Then we also close the bank account, and the closing balance of bank is 5,000 rupees. Then for purchases, the closing balance is 8,000 rupees. This balances which appears in the credit side are called debit balances. They are all debit balances. If those accounts again which whose balances appear towards the debit side are called, if the balances would have appeared on the debit side, then this balances would be the credit. These are all credit balances. So there are accounts which have debit balances, there are accounts which have credit balances. So after the balancing of all the accounts in the ledger, what we do is we write the name of the account. Suppose we have the cash account, we are preparing the trial balance. We write the heading as a trial balance. Then we have the debit side and the credit side of the trial balance. After that, we write the name of the account, and then the balances. If it has a debit balance, we write the balance on the debit side. If it has a credit balance, if the account has a credit balance, we write the name of the account, and then we write the balance on the credit side. For example, we have the capital account which will have a credit balance. So since there is not enough space, so I have not showed you the capital account, but the capital account will have a credit balance, so the amount will be written towards the credit side. Similarly, bank account, which is here, it is having a debit balance, so we write the name of the bank account, and then we write the amount towards the debit side of the trial balance. Similarly, purchase account, we write the name of the purchase account. The balance is a debit balance, so we write the amount towards the debit side. So the trial balance actually has various accounts. The accounts can be in the form of assets account. Assets accounts are like cash account is an asset account, machinery is an asset account. So there are assets account, there are expenses account also. Expenses account can be like salaries account is an expense account. Then we have rent account also is an expense account. So there are expenses account, then there are liabilities account. For example, loan account is a liabilities account. Then creditors are liabilities account. Then we also have the capital account. Then the income accounts also are there. So various accounts are there, and the balances are written towards the amount columns. And the balances can be debit balance as well as credit balance in the trial balance. Now, after the preparation of the trial balance, the next step involved is to prepare the trading profit and loss account. In the trading profit and loss account, we take all the income account towards the debit side. On the debit side, we write all the income account, and towards the credit side, we write all the income account, and towards the debit side, we write all the expenses account. So all the expenses account are filled up on the debit side of the trading profit and loss account, and on the credit side, we write all the, we show all the income accounts. After comparing the income and the expenses, if the incomes are more, we get profit, and if the incomes are less and the expenditures are more, the balance amount will be loss, which will appear on the side. After the preparation of the trading profit and loss account, the next important statement which is prepared is the balance sheet. The balance sheet actually has two sides. The left hand side has the liabilities account, the right hand side has the assets account. So all the liabilities and capital accounts, the balances of the liability and capital accounts, including the name of the accounts, appears on the liability side, and all the assets account, the balances and the name of the assets account are shown towards the asset side. So in summarizing, the steps which are involved is to balance the accounts, and then the ledger accounts, and then the trial balance is prepared, and with the help of the trial balance we prepare two important statements, that is the trading profit and loss account, the trading profit and loss account, and the balance sheet. Now, after summarizing the transaction, then the last step which is involved is interpreting the transactions. After summarizing, the step which is involved in accounting is to interpret the transactions. Interpreting transactions involves the presentation of the results of the business in such a manner that the parties interested in the business, such as proprietor, managers, banks, creditors, employees, etc., can have full information about the profitability and the financial position of the business. Now, by presentation of the transactions in the form of a trading account, and profit and loss account, it helps the users to have the information of the profit or loss it has incurred during the accounting year. For example, in this case, by looking at the trading profit and loss, we can see that the gross profit of the organization is 2,34,320, and the net profit is 1,28,970. The balance sheet helps the users to have the information of the financial position of the business. It shows the closing values of assets and the closing values of liability and capital. So it gives us the picture of the financial position of the business, and this presentation of accounting helps the users to know the profitability and the position of the business, financial position of the business. So I hope, to conclude this, I hope you have understood like the steps which are involved in accounting. In accounting, the steps which are involved are: number 1, identifying; then number 2, recording; classifying; summarizing; and interpreting. Now, identifying means to identify the transaction, whether it is related to the business, and also to see whether the transactions which are related to the business can be expressed in monetary units. Then once the transactions are identified, the next step involved is to record the transactions. The recording is made in the journal or in the subsidiary books. Then after the recording is made, the transactions which are recorded in the journal are then classified into various accounts in the ledger book. Then after classification, the next step involved is to summarize the transactions. In summarizing, the steps which are involved is to balance the ledger, then preparation of the trial balance, and from the trial balance we prepare two important statements, that is the trading profit and loss account, and then we also prepare the balance sheet. Then after preparation of the trading profit and loss account and the balance sheet, the next step which is involved after summarizing is interpreting the transaction. Interpreting the transaction means to present the information in such a way that it is useful to the users. That is, by making the trading profit and loss account and the balance sheet, it helps the users to know the profitability and the financial position of the business.